Welcome, dear traders. US CPI data showed that the authorities still have a long way to curb stubborn inflation. The US economy has once again surprised investors. Let's see what other factors influenced Thursday's trade. It's me, Kate Stichina, and you're watching a recap of the Asian session on September 14. The US Consumer Inflation Index accelerated to 0.6% from 0.2% in August, posting the sharpest increase since the beginning of the year. Roughly half of the increase can be explained by the rise in oil prices. Notably, oil prices surged at the end of August amid a decline in output and reserves. As a result, crude is trading near its 10-month high. In the near future, the global oil market may continue to tighten, so the most difficult period for central bank interest rate decisions may be just beginning. Nevertheless, the market continues to see little reason for the Fed to act aggressively. In yesterday's trading, Treasury yields spiked and the dollar rose sharply. However, both of these assets have retreated to lower levels. After all, the core inflation rate slowed to 4.3% in August, year-over-year, in line with the expectations. According to the FEDWATCH tool, there is a 97% probability that the Fed will keep its monetary policy unchanged on September 20. In addition, Asian trading takes into account a lot of economic data from the Asia-Pacific region, such as employment in Australia or private investment in Japan. The US dollar's reaction to the news was fairly muted. In Asian trading, the greenback continued yesterday's decline and traded within a narrow range of 104.50 and 104.80. The fact is that yesterday's CPI data was just the beginning of a series of reports. Today, the US will release reports on producer prices and retail sales. Tomorrow, markets expect import prices and industrial production reports. Therefore, the US currency was quite restrained against its G6 basket counterparts at the beginning of Thursday. It was trading near 104.70, taking into account the next reports from the United States. The Japanese yen was able to regain most of its lost positions as the US dollar was gradually sliding down in Asian trading. Early Thursday, the yen moved along the level of 147.30, the same level as at the beginning of the week. On a Monday, the yen strengthened significantly against the greenback after the hawkish comments of the head of the Bank of Japan. A few days ago, Kazuo Ueda hinted that the regulator may move from negative short-term interest rates to more aggressive settings. However, the Japanese business does not share the optimism of the central bank governor that the economy is improving. In Japan, the sentiment index for manufacturers sharply dropped to 4 points from a yearly high of 12 points. Japanese firms complained about elevated input cost of raw materials, weak foreign and domestic demand, heightened US-China tensions, geopolitical risks, and global economic uncertainty. Indeed, the same factors could be cited by companies in any other country. However, the main reason for the decline of a Japanese business is the weak national currency amid the Bank of Japan's ultra-loose monetary policy. That's why the markets were excited to hear that the regulator may change its dovish monetary policy. And this factor is the key for the Japanese currency at the moment. Supported by speculation of higher interest rates, the yen is strengthening. During the Asian trading session, the dollar-yen pair was in the bearish territory between the support of 147 and the resistance of 147.50. It seems that the yen's quotes are unlikely to change significantly in the near future. Meanwhile, the gap between the key rates of the United States and the Japanese regulators remains significant. At the same time, the gap may widen. The Fed is likely to make one more rate hike this year in November or December, and this move may prevent the US dollar from a large sell-off and help limit its losses against the yen. The Australian dollar also benefited from the temporary weakness of the greenback. As a commodity currency, the Aussie was supported by the surge in oil prices. Even the big yuan rebounded today as Beijing suggested that some major Chinese banks refrain from immediate purchases of the US dollars to ease pressure on the yuan. Supported by all of these factors, the Australian dollar rose above 0.6440 early Thursday. On the daily time frame in the Asian session, the currency also remained in the bullish territory within the range of 0.6415 and 0.6455. It's also possible that the Aussie was boosted by today's domestic data. According to today's reports, the Australian labour market added jobs in August. At the same time, wages also increased, although expectations for interest rates in Australia remain unchanged. And the global rise in commodity prices can make a difference in the long run. The New Zealand dollar saw its second consecutive session of gains on Thursday. It spanned the Asian trading session in range, approaching its weekly high. The kiwi is supported by a possible pickup in economic activity in China, New Zealand's main trading partner. The increase in the tourist traffic during the holiday season is also expected to boost the New Zealand economy. New Zealand Prime Minister Chris Hipkins, in his election speech, stated that the country's GDP was likely to accelerate slightly by the year end. And this was a great news for the market after the country was facing a technical recession in the first half of 2023, and the kiwi climbed to a high of 0.5930 on the news. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. See you online soon.